We have a great presentation tonight and a very informed and engaging speaker lined up on a pretty exciting and intriguing topic. As you've seen already on your seat, there's a complimentary gift for joining us here tonight. It's Wealth Redefined. That is Bob Reby's new book. Basically what it is, it's 30 years of financial planning and investment management experience put into a book, and it's kind of meant to be a guide to guide someone along the financial planning process. So if you're a client of Reby Advisors, I think a lot of the advice that you're going to see in the book is very familiar, but we are giving it away because I think if you take some time to read through it, or even just pick a few chapters to dive into that you think are interesting, I do think you'll walk away with a few nuggets of knowledge and wisdom that maybe you'd either forgotten about or you hadn't heard before. If you're not a Reby Advisors client, obviously the book is going to be fresh and new to you, and not only is it a great financial planning guide, in my opinion, but it also gives you an introduction to the firm, our philosophies and belief systems on wealth management and what we feel about money. With that said, Reby Advisors believes that financial planning and investment management is a very personal and customized service. So while the book can give you very high-level advice and kind of guardrails to work within, if you want really specific advice that's customized to your situation, that maximizes your chances of achieving financial peace of mind and financial freedom, please give Reby Advisors a call and keep us in mind for any financial planning needs that you have. So as you know, our topic tonight is the Trump economy and you. Our guest speaker, John Ross, he's going to be talking about the president's policies and how, if they're implemented, how they'll impact the economy, financial markets, and most importantly, your portfolio. He's from a firm called Rogers Casey. Basically, a couple of years ago, Reby Advisors Investment Policy Committee was looking for an independent and fiduciary firm to add another voice to our investment policy committee and give recommendations to our firm on how to reduce risk and potentially increase returns as well. And over the past 2 years, it's been a great partnership. All 5 of the asset classes and the strategies that Rogers Casey have recommended to Reby Advisors that we've taken, they've all worked out very well. The special guest speaker tonight is from Rogers Casey, and his specialization is in investment research, identifying macroeconomic trends, and then building outcome-driven portfolios based on that analysis and insights. So now I'd like to turn the mic over to John Ross. Please give him a warm welcome.
Thank you, Greg. Good evening, everyone. Good evening. So first, I want to thank Greg and Bob for inviting me to chat with you this evening and have a little discussion. And as much as we can make this a discussion, I'm happy to do that. If you have a question along the way or a comment, raise your hand. We'd be happy to stop and entertain any questions. I may at some point, if you ask a question that might be captured later in the presentation, I may say, hold that thought for a second, we'll touch on it. Or I may move things along just being cognizant of time and recognizing we want to keep this to about 50 minutes to an hour. So again, thank you to Reby Advisors for having me here, and thank you all for enduring the weather to talk about the current administration's policies. So let me ask a quick question. How many of you are familiar with the phrase, what, me worry? Anyone? Anyone know where that's from? Magazine, thank you very much. That seems to be a relevant, I'm sorry. Alfred E. Newman. Yes, thank you. That seems to be a relevant thought process these days where we have competing information and data. A bunch of data that's very good, and some other characteristics and conditions that drive some of our economic considerations that is challenging for sure. So let me just highlight a couple here. Operating earnings in terms of the market and operating earnings for companies are very strong. Sounds like today there was a little bit of a backslide given some mixed earnings results, but generally speaking, consistently higher earnings, and that's projected to continue. After our Fed and other central banks have pumped a fair amount of stimulus into the economies, seems like this low growth formula that we've had for the past several years will portend into the future, at least another year or two. At least that's what a lot of us are thinking. That might be a little troublesome in itself, that everyone's kind of saying the same thing, but nonetheless, that's where the data is pointing us. That will help U.S. companies in terms of their exports, right? The greater growth will help multinational companies and drive much of their sales internationally. Tax reform and infrastructure spending, two specific topics that we will highlight tonight, are still a little unclear, and we'll detail that for a bit. But it appears quite likely that taxes won't go down, and it appears also likely that at least some spending will happen for the military at the very least, and likely, again, more broadly for infrastructure projects. Consumer confidence and business confidence are both quite high. Housing starts and some other indicators, not quite as robust as we've seen in the past, but more recently have started to trend back upward. That's all positive. And then lastly, around inflation, and a key component of inflation is wage growth, right? To the extent that employees are earning higher wages, that drives prices up. We like to see that when we've had really, really low inflation for quite some time. A little bit of inflation is a good thing as long as it doesn't get out of control and too high. So I characterize those conditions and think about them relative to what we'll talk about tonight, and we'll characterize it as political risk or political uncertainties. And there's a distinction there. Things like taxes, spending, currency, regulation, tariffs, labor contracts, and environmental considerations are all part of this notion of political risks. And they're all interrelated. Seldom does one not impact another. From an investment standpoint, it's important to make sure that we understand that those types of risks are risks that we cannot diversify away. They're characteristics inherent to those drivers of market economies that go across many asset classes. So you can't diversify it away, but you can hedge for them, hedge for different outcomes relative to those political risks. And there's a couple of primary risks: the risks of drawdown or the risks of lack of liquidity. I kind of laugh this concept of a drawdown. About 3 months into my career was when the '87 crash occurred, and no one called it a drawdown, and no one called it a correction. You lost money. It's not, am I supposed to feel better now that my assets have corrected? No, I'm correct now, so we can move forward. It doesn't feel right, but the risk of drawdowns and the risk of liquidity and the effect that can have on your ability to trade and your advisor's ability to trade your portfolios is a risk we'll talk about tonight. So I mentioned a subtle distinction between political uncertainty versus political risk, and this will be an important component as we move through the topics we talk about tonight. Again, primary topics will be tax reform, trade policy, the regulatory environment, and the proposed infrastructure spending. Those are the four areas. But if we think about political uncertainty versus political risk, it's frankly a difference between sentiment versus hard data. So as we went into the election last year, there was a ton of political uncertainty, right? Just because A, we didn't know who the president was going to be, and B, we weren't clear on how the policies would play out. Well, there's a little more certainty around who the president is, but there's still a fair amount of uncertainty around policies. We've gotten a little bit of clarification on some of those policies, but in many ways, and we'll go through that, not a lot. So that notion of political uncertainty relates to sentiment, right? And that doesn't necessarily drive changes in markets until it translates to changes in data. Once we start to see hard numbers, whatever that might be, and it runs the gamut, once we start to see that sentiment translate into numbers that we can touch and feel, then we start to either identify risks more explicitly and act, hopefully making informed decisions relative to those risks, or we identify that the risk is dissipated and we make informed decisions relative to that as well. So that political uncertainty driving political risk or eventually translating to political risk is how we'll kind of frame up those 4 topics that we'll talk about this evening. And we're going to start with the white elephant in the room, I believe, and that's tax reform. So what I'd like to do first is just kind of go through and highlight the 5 primary areas for individuals and for corporations, the 5 primary changes that are being proposed as it relates to tax reform. And then we'll talk about how those in aggregate can drive markets. And for individuals, first is the whole notion of reducing the number of brackets from 7 marginal tax rates down to 3, with the possibility of adding 1 more top tier as it stands right now for individuals. So they're ranging, right now it ranges from 10 to 39%. They're essentially proposing to break that down to 3 brackets, 12, 25, and 35. Right, so the top bracket will come down a little bit, but they're reserving the right to still add 1 more top rate. Couple that with raising the standard deduction about 2 times, both for single and joint filers. And there's other changes in the tax code that are designed to make up for essentially the standard deduction increasing over time. The third is cutting the state and local tax deduction. So right now we all can use our state and local taxes as a deduction for our federal taxes, and they're proposing eliminating that. And there's a ton of discussion around how that's being used politically to position and negotiate give and take across the tax code. Fourth, eliminate in part or in whole the mortgage interest deduction and the personal exemption. I mean, those are 2 pretty significant deductions for anyone who itemizes. If you have home and you have interest on your loan or on your mortgage for the home, you can use that as a deduction. Now, that can be a significant deduction, especially for us here in Fairfield County and in the Northeast, where property rates are higher relative to many parts of the country. And then lastly, the repeal of the alternative minimum tax, or AMT, as well as the estate tax, right? So what I just highlighted, those 5 or 6 items, those are fairly significant changes to the tax code. Changes that we haven't seen since probably 1986, when the last real overhaul in the tax code occurred. So they're not insignificant. The same applies for corporations. First, reduce the top corporate tax rate from 35 to 20%. That's notable for sure. 40% reduction in the top corporate tax rate. Establish a pass-through rate of 25% for proprietorships, partnerships, and S-corps. So right now, those individuals that have that form of company are basically taxed at their individual tax rate. What they're proposing is set up a pass-through tax rate of capped at 25% to discourage people from taxing at their own rate, and hopefully, again, putting more money into the pockets of those individuals in those companies. Similar to the individuals, eliminate the corporate alternative minimum tax, not insignificant. Allow capital investment to be expensed immediately as opposed to depreciating it over time. What that will do the good is that companies can realize that capital expenditure right away. The bad news is we'll see greater variability in company earnings, right? So an advantage, but also a challenge as well. And then a change in the repatriation tax for international companies that earn money overseas, making it more cost effective for them to bring those earnings back to the States. Now, this all sounds great, but it's not cheap, and it costs money. So let's talk about some of the other changes that have happened. So since Obamacare repeal was not successful, right? They tried to repeal Obamacare in an attempt to save about $380 billion and create some of that, create some room to cover some of these tax breaks. So that the budget space was not created. Basically, the tax package has to pay for itself. And by that I mean, whatever the cost of those tax deductions are, there either has to be offsetting revenue generated from some other effort, or it has to be accommodated by increasing the deficit, right? That wouldn't necessarily be self-funding, but that's basically how they account for an increase in the tax code. So what we just described, the Senate passed a budget resolution on October 19th, allowing for what they call reconciliation, right? So we've heard about the splits between the House and the Senate for Republicans and Democrats. And basically, Republicans have a majority, but only by 2 or 3 seats, right? Normally, a pass of a bill in the Senate, for example, would require 60 votes. So if you think along party lines, when you only have 53 votes, including the vice president, when you only have 53 votes, it's a challenge to get up to 60. You've got to get, the GOP or the Republicans would have to get some Democrats to come to their side. Not an easy thing to do. This whole notion of reconciliation allows for just 51 votes as opposed to 60 for bill passage, but it requires some additional hand-holding, if you will, around changes in the tax code. So that reconciliation has been approved, so they don't need 60 votes, they only need 53. Right now, the estimated cost by the White House for the tax program is about $1.5 trillion over 10 years. So they've got to find some way to crack that $1.5 million nut over 10 years to pay for those potential changes in the tax code. The White House also has plans to cover the costs. I had mentioned there's other ways that they can generate revenue. So they're intending to do that, primarily through some energy-driven initiatives. And in their minds, ultimately, they're going to earn about $2.5 trillion with those revenue initiatives. So they'll more than cover the $1.5 trillion of tax cost and also reduce the deficit by another $1 trillion, calling that fiscally responsible. Sounds good, always does on paper. Others estimate, and I'll use that kind of loosely defined, estimate the cost to be north of about $4 trillion as opposed to $1.5 trillion. So obviously that would increase the debt for the United States, increase the deficit, and one metric that's often looked at by countries is they refer to it as the debt to GDP ratio. How much debt do you have for the country relative to the amount of GDP or relative to the amount of economic growth you contribute? So basically that would increase that number for us from about 77% to just over 100% over 10 years. 100% is not a good number. Now the rating agencies start to look at us as a country, start to price our bonds more expensively because then we're perceived to have more risk. So once we get that debt cycle going even more than it already has, it's looked upon negatively by the rating agencies, and now our bonds become more expensive to everyone, to us and to foreign investors, and less attractive, maybe, relative to other countries that might be perceived to have less risk than us. So this whole notion of the tax cut and how much it costs and how we're going to pay for it is an important component, and will affect markets for sure. So how does that affect markets? When I highlighted the positive positioning of many of the market metrics in my opening comment, a lot of those metrics were in place prior to the new administration getting into office, right? Certainly, that you might have heard it referred to as the Trump bump, right? So there's been a little bump in the markets since Mr. Trump has taken office. Many argue that the fundamentals in the economy were in place even before Mr. Trump took office. That being said, he has made some decisions, and the administration has moved ahead on some of their initiatives that are all kind of what I'll characterize as growth related for the economy. So that's all positive. The U.S. economy is in a pretty good position. Like I said, corporate profits are strong. That holds true in some of the global economies as well. Developed non-U.S. markets in the Eurozone are coming off strong positions. The emerging markets had a bit of a struggle in the last year or two, but have since kind of stabilized. And they've always had relatively strong balance sheets, many of them. So globally, we're in a pretty good spot. At least that's what it feels like. So the next couple of months will be interesting to see how the administration and how Congress push ahead the tax reform package. We've already heard, I heard just on the drive here this evening, the whole notion of 401ks apparently was on the table and whether they should be maintained or not. And President Trump said, I want to make it clear that I want 401ks as part of this, as part of our ongoing investment options for, in particular, we referred to the middle class, which I think is reasonable. But there were folks on the Democratic side that were thinking about removing the removal of 401ks as a negotiating pin to get some other concessions in other parts of the tax code. So it's that kind of give and take that we were going to see a whole bunch of, frankly, over the next 2-3 months. And let's be clear, the administration needs a win. And we'll talk about some of the things that they've done from a regulatory position in a little bit, but the administration needs a win. Obamacare did not get repealed. They didn't save that money. That put pressure on their budget efforts. We'll talk about some of the trade agreements and the pressure that's put on. So the administration needs a win. It's probably not going to come quick and easy as it relates to tax reform, but it's important that they get something. So let me just take a quick second here and talk about what that means for markets. So I've already positioned the markets in a pretty good spot. And I would characterize, actually it's not I, it's we, Rogers Casey, would characterize as still in political uncertainty mode as it relates to tax reform. We don't think we're quite to political risk mode yet. How they get the tax reform paid for ultimately is going to be a big component of that. And the market is anticipating some form of tax reform in the next 3 to 6 months. Whether it gets done in the fourth quarter, in the first quarter, hopefully it's the fourth quarter. The market has already priced in some improvement, whether you call it tax reform or tax revision. So maybe it's a little lesser version of tax reform. The market has priced that in, and that contributed a little bit to that notion of a Trump bump, where markets have continued to go up here over the past 6 to 9 months. Remember, the market is a forward-looking instrument, right? It projects forward about 12 months how it thinks the economy and how it thinks companies are going to perform. There's a whole bunch of dynamics that drive that, corporate tax reform being one. So that has been priced into the market, causing the U.S. market in particular and valuations and the price of stocks to go up. So despite the fact that the economy looks pretty strong, the market's reflecting that, right? It's on a relative basis, looking at different pricing mechanisms, it's a little bit on the expensive side. It's not crazy expensive, but it's not cheap either. So we recognize that going in, and remember that whole notion of expensive versus cheap is a relative comparison, and we'll talk through some of the other markets as well. So what does that mean for us as investors? And I'll characterize asset class groups, and I'll refer to risk assets. So things like equities, to a certain extent, real estate and infrastructure, things that have a perceived risk premium attached to them are still relatively attractive, even though valuations are a little bit higher than we've seen historically. So we think risk assets are still okay. Relative to fixed income, that's a bit of a different animal, and I've purposely chose not to talk about the Fed yet. In a Q&A, if that comes up, I'm more than happy to go there, but relative to interest rates, we all know that the Fed is a key driver of changes in interest rates, and fixed income instruments are priced in part directly off of changes in interest rates. Right, so as interest rates go up, which they're anticipated to do, generally speaking, the price or the cost of bonds goes down. Right, so you lose money, you have that drawdown or correction in the bond market as interest rates go up, and we fully anticipate that rates will go up, perhaps at a slower pace than the Fed might be projecting right now, but we fully anticipate rates to go up. So on the fixed income side, we're thinking neutrally. Get exposure across the spectrum. Make sure we think about exposure to other fixed income instruments that have we call it a credit risk attached to it. So corporations that have some kind of risk attached to them as an individual entity, in addition to treasuries and foreign securities. All relevant there. Are there any questions, comments? Yes, sir.
A question or a comment. The 2% increase in your base wage earned.
Yes.
It's going to go from 10 to 12. Has anybody done a study of the economic effect of that? Because that 2% is going to have to be made up by the small business owner.
Yes.
Small business owners have to make it up because the employees can't pay the 2%. Therefore, they're going to have to either lay people off, which is going to have an effect on the economy, or if they end up eating it, they're going to be buying less from their major suppliers.
Yes.
So it sounds, great when you first look at it and the other stuff, but I think it's an economic disaster waiting to happen.
So if I may, I would characterize that as a comment. I forgot to mention my objective is to be apolitical tonight. I am going right down the middle. Agreed, but I forgot to mention that too. No, I couldn't agree with you more. I think it is whether it's that 2% increase or other increases that are attached to at the federal, state, local level. It's those challenges exactly that will continue to be a headwind, or I should say, or may create a headwind for the continued growth of the economy. I mean, you've stated it perfectly.
I did something right,
but it's those trade-offs that we try to think about as it relates to changes in valuations and opportunities that will present themselves, not necessarily today, but 6 to 12 months from now. And a lot of what we're talking about is a short to intermediate term kind of consideration, and I characterize that as a 6 to 18 month time period. And then there's a couple things that are longer term in nature too, say 5 years plus. Yes?
As the rates go up, what does that do? I mean, I know with the bonds go down.
Mm-hmm.
With the annuities, a lot of people talk about as you start getting older, you should have
Yes.
an annuity. What does that do to the annuity?
Depends on whether you're in them already or if you're looking to get into them, right? So
Looking to get into them.
if you're looking to get into them, as rates go up, annuities, and I have to characterize generally here, it varies from strategy to strategy and product to product. But generally speaking, as rates go up, annuities become more attractive. You can essentially discount that cash flow. So you're looking for a cash flow in the future, a monthly or annual cash flow. You can discount that at a higher rate, right, as rates go up. So they become a little bit cheaper today. That's why annuities have not gotten a lot of interest over the past periods because rates have been really, really low. So they've been a little bit on the expensive side. So if you're looking to get in as rates go up, annuity prices, and again, depends on the provider and the circumstances and the fees, come down. And I don't want to bridge into RIA into Reby's expertise, but that should be the thought process. Yes, sir.
With this new plan, the tax changes in the percentages, now for older people like us,
Yes.
who are on fixed income,
Yes.
I think currently we are paying 15%.
Yes.
If they take away all the deductions, which we have quite a few, how does that compensate us having more money since they taxed my Social Security?
Right. So what they're intending to do is to make up for the loss of itemized deductions in the form of a higher single rate deduction. Right. So I mentioned that they're looking to double that item, the single rate deduction for joint filers and for single filers. I believe it was from 6 to 12,000 and from 12 to 24,000. And I'm not a tax expert by any stretch, but so there, and it'll vary from obviously individual to individual, but to a certain extent from region to region. And I mentioned that we here in the Northeast and Fairfield County especially have relatively high real estate rates, right? Right, and in New York. So that mortgage interest deduction is a big benefit for us, probably more so than someone in Iowa, just generally speaking, right? So and they haven't attached ranges, they haven't attached limits to any of the three new buckets. There's a ton of uncertainty still around exactly how those three buckets break out and what it means for individuals. So, I mean, that's exactly the question you should be asking. And hopefully as we get more information, we and tax professionals will be able to answer it a little better. Okay, if I could, I'm going to press ahead. So just one last comment on tax reform. A question might be, how does this affect municipal bonds, right? Which are tax advantaged and are typically a part of many folks' portfolios. We think that, and this is from a theoretical standpoint, based on Rogers Casey's views of municipal bonds and the benefit and the role that they play. Munis, for the most part, they're not dispensable. They're not going to get rid of them. They're not going to totally eliminate the tax credit, or we would be surprised if they did. It's a cheap form of debt, basically, for cities and states to pay for their expenses. There are some kind of offsetting factors as it relates to the rest of the tax code that can drive changes in prices. So we mentioned lower corporate tax rates may reduce kind of the corporate issuance, right? So to the extent that corporations have lower rates, they don't have to issue as much debt, they have more retained earnings or more profits, that could reduce corporate issuance and therefore increase the attractiveness for yield for muni investors, right? A lot of us are looking for yield. We're looking for steady income as we move into retirement. So if corporations don't provide that, now muni bonds become more attractive, and that might drive the price up, right? So that's a dynamic that we need to think about. And then also the notion of lower personal tax rates might make munis kind of marginally less attractive than they are today. So if you're a muni investor, you're looking to cover essentially your tax with a non-taxable investment, right? Any tax that you have to pay, you're looking to offset it somewhat with a non-taxable investment. If your tax is actually lower, then kind of logically, you may not need as much of a non-taxable investment to cover a lower tax. So that's another dynamic that can drive the supply and demand of munis, and as a result of that, the price. The last comment here, even in today's market, munis priced at a 33% tax rate, if you're in a 33% tax bracket, can still provide a tax advantage for most investors. So the whole notion of bringing that maximum tax rate down to 35%, even at 33%, munis still look attractive. So again, still a lot of details to be worked out. If I could, I'd like to move to the second topic of trade, and I'll move through this relatively quickly. First, and I'll focus on two specific trade agreements that you might have heard of. the Trans-Pacific Partnership, or the TPP, and NAFTA, the North American Free Trade Agreement. The Trans-Pacific Partnership is an agreement that was originally between 12 countries that basically was designed to promote economic growth in any number of a dozen ways that you can think that could happen. Whether it's managing inflation, raising living standards, reducing poverty, all of that kind of stuff that goes into economic growth is what it was designed to do. The United States, it was designed to focus on North American countries and Southeast Asian countries in particular, kind of bridging the Pacific. The United States was one of them. President Trump, during his campaign, said one of the first things he would do is to get out of TPP, and that is exactly what he did. So we are no longer one of the 12 members. Now, those 12 members accounted for about 40% of the global or world growth. With us out, we accounted for about 3/5 of that, 40%. So it's a significant hit, if you will, to the effectiveness of that consortium. However, they've still stayed together. They're going to press forward with the TPP. I heard just on the way over. Singapore is one of the other members. And in discussions, the Prime Minister of Singapore basically said that the U.S. has lost credibility in terms of trade agreements, given our approach to the TPP. So now that could just be posturing, right? Suddenly Singapore, relative to the U.S., with still 10 other countries next to it, might feel like it's in a little stronger position to say, you know what, United States, you acted arrogantly, and we don't think you're credible. Or they might have just been positioning, or they might actually feel that way. So to be determined. But notably, the TPP did not include China, and by design, it's designed to direct trade away from China and to not only the United States when we were a part of the TPP, but to the other 11 signatory countries. So the good news there is we weren't actually in it yet, unlike NAFTA, where we've been in it for 25 years. We've experienced probably good and bad around the NAFTA, the North American Free Trade Agreement, right? So it's basically an agreement that establishes that same notion of promoting economic growth between Canada, the U.S., and Mexico. We've been in it for 25 years. Ross Perot, the other billionaire who ran for president back in 1992, characterized it as this huge sucking sound going south, quote unquote, if you remember that. He almost ran on that, I think, as his logo. But that was all pointing to the notion of the wage differentials, in particular in Mexico, would be a driver of this change in manufacturing and jobs from the U.S. to Mexico. To be clear, we did see some of that. Depending on measurements and estimates, through, I want to say 20 years, through about 5 years ago or so, they estimated about 650,000 jobs went from the U.S. to Mexico. But that also has been offset by the fact that 40% of our imports from Mexico now are generated through NAFTA. Right? Back then, it was only about 5%. Right? So there's been give and take for sure, and it's unfortunately we don't have any way to go back and see how we would have done without NAFTA. And it's not a metric we can look at. Luckily, and I think a lot of folks had trepidation during the election about the tough talk that Mr. Trump was saying, whether it was related to tax reform or trade agreements. But the tough talk relative to trade agreements has moderated a bit. He characterized NAFTA as the worst deal ever made in the history of the world. Canada and Mexico apparently called him 3 months ago or so and said, don't terminate the agreement, negotiate with us, which he has done, or he agreed to do. Perhaps his hard stance on the TPP set a precedent for them to come to him and say, can we work this out? So they're taking 3 lighter, I would call more administrative steps towards revising NAFTA as opposed to bagging it. Tougher enforcement of labor and environmental regulations in Mexico. I think we're all probably familiar with the notion that not a ton of environmental regulations there. Update the agreement with information, age, technology, and issues and products, right? So to the extent technology has advanced and NAFTA hasn't, the agreement itself hasn't kept up, incorporate those, and then change the dispute resolution process. And that just relates to the disputes that might occur across the countries over the course of trade. So we talked about political uncertainty versus political risk. We have certainty with TPP for sure. We're not going to be a part of it, but now it's created other political uncertainty with the existing members of TPP. We now are moving in a direction of more political certainty with NAFTA. It's not going to be terminated. It's only going to be modified, and I would say administratively. So that's a plus, but the bad side of that is NAFTA has now been pushed to the back burner a little bit. So they're not meeting again until the middle of November, and they just finished the 4th of 7th meetings to try to renegotiate this. So there's a good chance it'll get pushed into the first quarter, which would not be looked positively upon by the rest of the world, if you will, and potentially by investors. So that means now that political uncertainty might be moving closer to political risk again. And maybe we'll start to see some of the markets react, and perhaps we won't. So unfortunately, not sure exactly how that'll have an effect. A little bit of a mix there. Moving on to the third component, infrastructure. Let me take a quick breath. Any questions on trade agreements? NAFTA, TPP? Okay. Infrastructure. So the president ran on a policy of spending $1 billion on infrastructure spending. What is infrastructure spending? It's basically money that we spend to maintain our bridges, our roads, our waterways, and it also involves creating new technology as well as investing in the existing technology for things like water treatment plants and renewable energy resources and the like. So he talked about $1 billion. He's now tapering that number as well, and he's basically targeting leveraging $200 million with other existing and private commitments to get a total impact of $1 billion in spending. So again, I think the notion there is being mindful of increasing the deficit. Right? If you spend $1 billion, that's going to go straight to the deficit. So let's spend $200 million. Let's identify some opportunities where there's already money either earmarked or committed, and kind of piggyback onto that, and say carves out $50 million to spend on an energy plant, and I'm just kind of making this up, that costs $300 million. Well, now he's spent $300 million of his billion, or attached himself to $300 million in improvements towards that $1 billion number. That's not necessarily a bad thing. I think it is fiscally conscious to want to minimize the spending as long as we're meeting the desired objective of maintaining our infrastructure and keeping our roads and bridges safe. So the goal there is to create a framework that's more flexible and adaptable. So there's three possible outcomes. One is the piggyback, the notion of piggyback and leveraging a smaller amount of money. Second is focusing on rural areas that are less attractive from large institutional investors. So there are loan programs in place today that are relatively effective as it relates to infrastructure and other investing. So they would likely leverage those loan programs and attach an infrastructure name tag to it and say, this is a loan, or it's a grant, or whatever it might be. But do so in whether it's state level or municipality level, so that the bridge down the road can get some funding as well as the Tappan Zee Bridge, right? So get some federal funding. So looking bigger picture, looking more local, and then lastly, creating opportunities to fund, if you will, that whole notion of technology and incorporating technology in the infrastructure program building bridges smarter, finding more effective ways to treat water waste, and the like. So from an investment perspective, what we've seen more recently is kind of a stabilization of commodities. So things like raw materials that would go into some of the infrastructure spending. We've seen a little bit of a stabilization after a downturn for quite some time. So it further supports that strengthening or that stabilization of commodities to the extent that we can put that money to work, both domestically and globally. So that's not a bad thing. And the U.S. isn't the only country or region that's talking about, a significant investment in infrastructure. I think the world infrastructure has a challenge there. The world has a challenge in terms of maintaining infrastructure. So things like commodities are good. Investing in infrastructure in itself is a good thing. We think that's a relevant place to be and have for some time. And then lastly, it supports, in particular, some of the emerging economies, some of the smaller economies that are very much raw materials based or commodity driven. So to the extent that increase in demand for commodities, increase in demand for raw materials drives improving infrastructure, that'll continue to help some of those emerging economies as well. Both equity and fixed income are emerging market debt, to the extent emerging markets need to issue debt perhaps to cover some of their own infrastructure spending. Any questions on infrastructure? Yes, sir.
So you said $1 billion for Phil?
That's his original comment was $1 billion. And
I'm not even sure that's even a conversation. That's not even a conversation.
I'm sorry, geez, I'm sorry, trillion. Thank you. I'm sorry.
The Z Bridge alone is $4 billion. The water bridge is $3 billion.
My apologies. $1 trillion, and he's backed it down
Now
to.
we're in a conversation.
Now he's backed it down to $200 billion that he's looking to piggyback and invest. Yes. Sorry about that. Thank you. Anything else? Appreciate that. Okay. Moving on. Lastly, to regulation and deregulation, and I think we would kind of classify this as probably the fourth level driver or fourth level determinant as it relates to what we're talking about this evening. This is one area where Mr. Trump has been fairly consistent with his campaign platform, where he was intent on, if he could, stopping all regulatory activity in its tracks, if you will, in his mind or in the administration's mind. The notion was to stop the bleeding, stop the government bleeding in terms of supporting from a regulatory perspective. So both major and minor regulatory changes have virtually come to a standstill, and sometimes some would argue for the better, and again, sometimes not. So while we have 15 small regulations that have been put in place for this administration, where in past administrations it's been upwards of 90 over the first 9 months, right? So while it has slowed, there are some agencies that were expecting certain regulatory changes to be pushed through that have not. So one in particular sounds a little funny, but the FAA was looking for finality, if you will, on the regulation that would limit drones basically over covering an individual or following an individual. Right? That's not in place right now. I believe there's one piece of regulation left that would complete that, and that's now been stopped. At some point, I would expect, or I think one could anticipate, that some of those will likely go through. But so that there's good and bad in terms of the change there. The larger ticket item in terms of regulation was the repeal of the Dodd-Frank Act. So if you're not familiar with the Dodd-Frank Act, it was an act that was put in place after the great financial crisis of 2008, 2009 to try to regulate the finance industry, and I'll characterize that broadly, financial industry. so that we wouldn't have banks running out of control and getting out of control with the loans they were making. They essentially had to have capital and liquidity constraints put in place and that they have to maintain today. So it was designed to kind of minimize the potential for a 2008 to happen again. The repeal of Dodd-Frank passed the House, and that's as far as it got, basically. It's essentially dead. But that's not to say that there haven't been other administrative kind of enhancements that we would characterize more as evolving as opposed to revolving, evolutionary versus revolutionary. So smaller changes on the margin. The challenge there, you've still got Republican and Democrat people that are driving that change, right? So there's still some Obama folks and there's some Trump folks that are driving that change. So it's a bit of a deadlock. So in terms of the markets, that may work its way into the markets. we would expect that would take a little bit more time, and perhaps on the margin, to the extent that banks, let's say the regulations ease up a bit, banks could ease up on their lending practices, make capital a little more available, not be required to hold as much in terms of capital reserves and liquidity, so they could put that money to work as well. So that might take a little bit longer. In terms of the four groups, I would characterize that as the fourth driver for sure, but still not insignificant. So what we've tried to share with you tonight is we have some certainty, a little more certainty in some areas, a lot of uncertainty still in a lot of areas. The economy as a whole, both in the United States and globally, is fairly well positioned. There are pockets that are a challenge still, for sure, which we think drives the importance of kind of thinking actively about those markets, especially outside of the U.S., and also being aware of how the markets are changing, not necessarily over the short term, but what the directional shifts are. We're not proponents of looking at markets quarterly, even though we do, or once a year. But thinking about what your asset allocation is on an annual basis, making sure that it still matches your risk tolerances and preferences and your objectives as an individual, and looking ahead, thinking longer term, and making sure that they're all kind of in sync as best as you can make them, as best as any of us can make them over those different time periods, we think is important. That concludes my prepared comments. Any other? I have 5 minutes to spare. Any other questions? Yes.
The tax package that Mr. Trump is promoting.
Yes.
Does not go through.
Yes.
Do we go back to pre-Trump prices?
I would expect, we would expect probably not all the way back to pre-Trump prices. There might be a correction. Make you feel a little better about being corrected. Probably not pre-Trump prices, only because of those underlying fundamentals that are still relatively strong. So they have been in place, and to the extent those contributed to a portion of the growth that we've experienced over the 9 months, and we believe they have, that still supports some of the pricing enhancement that we've seen, some of the price appreciation we've seen over the past 9 months. So probably not pre-Trump prices, but there will be, I'm not sure exactly what the specific driver would be, right? There's any number of them. And there are different sensitivities to them too, but probably not pre-Trump prices. Yes?
Most economists will say that the national debt is unsustainable.
You said unstable.
To me,
Unstable? Unsustainable, thank you.
And to me, it's the stealth issue of all the big problems we have. Because it's not sexy, it's the last thing, who's an
techie nature
Yes.
to really think about it.
Yes.
But if we ever told our children to run their finances like we are running our government finances, I mean, we would never do that. And yet the last 3 presidents have continued to build that debt. It's going to catch up with us at some point. God only knows when.
Right.
When are we ever going to address that? Any thought on that?
I mean, I think we think that we've made some progress as a nation around addressing that phenomenon, and you're absolutely right. And it's not just the last 3, right? You can go back further as well, but we've made some progress around requiring balanced budgets, right? So basically, what has been said, and I referred to the $1.5 trillion cost of the tax package, right? You've already seen senators on both sides of the table come out and say, this thing is going nowhere unless it's self-funding. You know, whatever number, whether it's $1.5 trillion or 3.5, this isn't going to go anywhere unless it's self-funding. And it's not relatively early in the process, but they still have time to try to figure that out. So I think the sentiment that you express is becoming more and more common in some of our leaders in Congress, and as well as in the presidential ranks. But I mean, it's a fair question, and I don't have a great answer for that, other than to say, you know, it's a directional change that we need to see continue to be employed and applied across, a lot of areas in the government, as we would do as individuals, right? I've gotten into debt for sure, but at some point you step back and go, okay, this feels like it's just not a good thing, and you try to take steps, and it's not going to happen in one fell swoop. There's no silver bullet, but you try to identify opportunities where you can take steps to improve a little bit at a time, change your spending habits, change your saving habits. Same thing applies to the government. So I don't. That's not a great answer, but I mean your point's well taken. It's at some point we need to be increasingly more fiscally responsible. Yes.
Corporate earnings are the driver of equity prices.
Yes.
In your opinion, what are the most 3 items that affect corporate earnings and those prices?
Okay. I will start with, and I'm going to say after-tax earnings. I will say tax rate for sure, and that runs the gamut of tax rates here in the U.S. as well as I mentioned very quickly the whole notion of the repatriation tax, right? Where a lot of our companies are global in nature and earn money outside of the states. They make it in other countries. It's expensive to try and bring it back into the states today, right? A softening of that repatriation tax, or the notion of repatriation, is certainly a component of that. So I lump that into the tax rates. Second, in terms of drivers, I think one of them, and it's an indicator of the broader economic cycle, is inflation, right? I mean, to the extent that inflation can be controlled and work itself into the economy in an effective way, right? A little bit of inflation is good, we could spend another 2 hours on whether so the Fed targets a 2% inflation number today. They hope that we hit 2% every day or every year. One could argue that that's way too restrictive, given some of the changes that companies have made to improve their profitability in the face of low growth or in the face of recessions, and it varies from industry to industry. But companies are notorious, as we all probably know, for doing more with less, right? When times get tough, they tighten their belts, downsize, right size, whatever you want to call it. And even when times are good, they're doing the same thing. That's probably the time you should be doing it, right? So inflation as an indicator of stronger economic growth, stronger supply-demand dynamics, clearly that's a driver of corporate performance. So taxes, kind of the broad economy, and then really it's an information advantage, right? So to the extent a company is in an industry and has some kind of an information advantage that has a perceived value add for us as investors. And that can be a wide range of considerations, right? But basically a basic position for an information advantage and applying a consistent thought process on how to take advantage of that, right? So having a consistent thought process on taking advantage of whether it's information, you can broaden that to any advantage that they might have within their industry, but having a consistent approach. That answer your question? Sure. Anything else? No? Great. I thank you all for your attention.